All that matters is what Jay Powell has to say. We should be doing a watch party for Jay Powell's speech in Jackson Hole, Wyoming today.
I'm just hoping that interest rates don't go up anymore.
I mean, just the whole thing. It's not just where rates go. It's just the whole thing. We have all these czars now, which is I've said for years. It's just so odd that we embrace, both parties, we embrace this use of a term from Russian royalty to describe mainly administrative officials in our government. Maybe that says something about the ruling class mentality and our lack of recognition of how they view themselves and how they view us.
Yeah, John Kerry is the climate czar.
Starting to come into focus. Drug czars and climate czars and
weird
monetary czars. But Jay Powell is more than that. He's also a fiscal policy czar. And the czar has been quiet on fiscal policy and how that leads him to do the things he does or doesn't do. So what can we expect to hear from Jay Powell? What impact will it have beyond the short-term market response today? Scott Shellady, Scott the Cow Guy, is the market specialist from Market Day Report. That's 10:30 to 1 Chicago time. He's also the host of the Cow Guy Close, 1 to 1:30, both at RFD-TV. Scott the Cow Guy, thanks for joining us.
Good morning.
So do you have all your fixins set out for your viewing of Jay Powell's speech today?
Yeah, I've got the low carb potato chips and
good.
all the good ones. Yeah, look, this sometimes can be a market moving event. I mean, he's roiled the markets before at this time of year. I don't know if that's going to be I think he's going to try to do steady as she goes. But what does that mean? I mean, he's kind of in a little bit of a pickle right now because there are a few things that are saying that the economy is strong, which are things that the Fed actually does look at. But at the same time, there's a lot of things that look like they're melting down around the economy too. So he's got a great jobs market, or at least if that's what you believe. I'm not quite sure that jobs number is correct, but we got apparently we have a 3.5% unemployment rate, which is like a 40-year low. And at the same time, I don't know what these people are smoking, but the Atlanta Fed's coming out with a GDP production for the third quarter of a 5.8% GDP. Now, put it into perspective, Japan's at 1.5, Eurozone is at 0.3, the United Kingdom is 0.2, and they're saying we're going to be 5.8. And now, by the way, everybody knows China lies. China says they're going to be 4.5, so we're even beating the liar. So we'll see what happens.
Well, with respect to what he has to say today, the lack of commentary, as I sort of mentioned, on fiscal policy. I mean, if you're looking at a 5.8% GDP number, then steady as she goes with the industrial policy gambits like the Inflation Reduction Act, the Chinese. What did Chris Whalen call it yesterday? The Chinese Stimulus Act or something like that?
We call it Inflation Production Act.
Inflation Production Act, right? So combine that with, by the way, nearly 4 in 5 Americans think that things are not going well economically. So steady as she goes is not exactly the message they're looking for.
No, not. And to think that they're the word is they're worried about maybe another rate hike. There's a 50-50 chance, not this meeting, but the next meeting. Right now, the chances that they think it'll be a 15% chance that they hike rates. But we're still talking about tightening or raising interest rates. Which, I mean, I can tell you by doing my show and hearing and seeing what our listeners say, 2/3 of America is really feeling a pinch, and 1/3, who actually happens to be the ruling class, they don't care. And now we've started to see study after study come out to say that, hey, the NFIB, the National Federation of Independent Businesses, has said that 50% of small businesses believe we are in a recession right now. And yesterday was interesting. This economic group called the Oxford Economic Industry or whatever, they came out and said, look, the consumer, which is what everybody's been banking on, and that happens to be around 70% of our economy, is now crash landing us into a recession. They feel as though that the consumer is now finally tapped out, And this is going to be something that we're going to have to keep an eye on. Now, the Fed's they've gone down this path of saying, I'm sorry, we might have rates higher for longer. Now, that's gone, that's twisted the lexicon that everybody's been talking about it, and I'm sick of hearing it, but are we going to have a soft landing, or are we going to engineer a hard landing? I mean, all that garbage, right? On my show for the last 6 months, I've been saying it's going to be neither. It's going to be a long landing, and I think that that's what the Fed's trying to tell us, that you better be ready for interest rates to be 5, 5.5, or maybe even 6% for a lot longer than you thought, because that looks to be the case here. And the folks that think we're going to get a rate cut anytime soon, if you get one, it's because there'll be some sort of economic calamity happening at your feet right then and there. It's not because the market will be able to call for one. It'll be because, it's hit the fan.
Well, give me an example of an economic calamity that could happen.
Have a 20% sell-off in the stock market because, the Fed has done something that the market was surprised about or didn't like, or everybody's pulled the rug out of this, underneath the feet of the artificial intelligence stocks. Some sort of black swan event that happens in China that really affects us here. I mean, something like that surprises the market that nobody could see, then you'd have to cut rates. But to cut rates without having that in sight, to me, is unfathomable. And again, the market's still thinking about hiking.
Well, and we also have, correct me if I'm wrong, the market building in things that we know are coming, like a reckoning with commercial real estate, and particularly in metropolitan areas, right? So when you see defaults, and maybe even additional bank insolvencies in the offing, end of this year, beginning of next year, when more of these notes are due, that's already been built in too. There's an expectation that's going to happen, so that is going to be received as, we sort of expected that.
Yeah, and that's a great point, because there's a psychological aspect to all of this, and that's kind of what I said to Amy there, is that markets just hate getting surprised. That's when they have those big sell-offs. Yeah, the commercial real estate sector is absolutely horrible, but the problem is, Dan, is that there is a sector of economic pundits that believe that everything is hunky-dory, and part of them are all on board the Bidenomics garbage, and part of them think that because artificial intelligence has propped up all these stock indices and the unemployment rate's at 3.5%, that we are just firing on all cylinders. America is great, and let's go. But most other indices or most other indicators are telling us that we're in trouble. I mean, that bank lending window that the Fed opened up with everybody, with the FDIC and the Treasury in March and April earlier this year, to help shore up other balance sheets of banks that were looking to go under, like SVB did. Nobody's talking about it, Dan, but month after month, that is setting a record after record in withdrawals. Each month it's more than it was the previous month. These small banks are still wobbly.
Well, but that's sort of the point too. Is everything's hunky dory because you've got the federal government backstopping banks that matter to them.
Yes,
right?
And so I don't take it lightly like a lot of other people do when Fitch comes out and says, "Hey, if you're not careful, we're going to downgrade some of your biggest banks, U.S. Bank, J.P. Morgan." I mean, that's fairly serious and should be noted, but we shrug it off, which I think is ridiculous. But right now, that's what the market's doing.
But the other side with the downgrading U.S. credit, I mean, I know you're talking about the prospect of downgrading the credit ratings of banks, but the Fitch downgrading of the U.S. credit, that was a surprise, and the market reacted poorly to it. But it's sort of a funny thing too. It's sort of a like pretending to care about the $33 trillion in debt. And maybe we shouldn't. Maybe we shouldn't that much, not because we are proponents of profligate spending, but because who are our creditors? It's sort of the old saw that if you owe the bank a little bit, the bank owns you. If you owe the bank a lot, you own the bank.
Say that in trading, right? You lose $100,000, you got a problem. You lose $100 million, your clearer's got a problem.
Right, exactly. So, I mean, but isn't there something to that? And isn't that the way that certainly the policymakers look at it this way? I don't know how the markets look at it anymore, because I don't know what kind of market we really have when there's all this rent-seeking behavior going on, and the chasm between corporate America and Main Street America grows wider by the day.
Well, you're right. And so here, I'll cut to the chase, is that no. With the U.S. default, no. And when you talk to the liberal left-leaning professors, when we own the printing press, there's no chance you'll ever default. You'll just print money and pay whatever you have to pay. That's their line of thinking, and that's understandable. But at some point in time, if you continue to have these issues where you do have such high service for your debt, when you have to print money to even pay the debt service or each to try to keep your bank, your books balanced, you could have, and I think this is what will happen ultimately in the end, you could have a structural default where all the bondholders are now being paid back in dollars that are basically worthless because you've printed so much money to pay people back all the debts you owe them, right? So there is a higher, I think Fitch is leaning more towards a higher likelihood of a structural default where you're paying back all these people, these creditors, with dollars that have been printed and are actually, worth absolutely nothing.
What's your latest, greatest take on crypto with some pullback of Bitcoin, and also some talk that if we do see a market downturn towards the end of this year or the beginning of next year, then maybe you'll see crypto be marginalized again? I mean, it's sort of an odd place, because on one hand, I see a lot of blockchain activity and investor interest in blockchain technology. On the other hand, there's still a lot of debate about whether crypto, at least in the form of things like Bitcoin, is really going to be the future, even as we move to a cashless society.
Great question, and typically I would say right now I don't like it. I've never invested in it. I've never put a customer in it. I do not like crypto. However, I am starting to slowly but surely change my mind for two reasons. Number one, central bank digital currencies. When the government comes and is going to slowly but surely have Dan and Amy paid from the Fed instead of being paid from AM 560.
Yeah.
When they have full control of your money and how you spend it, I think suddenly there is a base case for Bitcoin, not because of the other things that they like Bitcoin about, but just another place that you can have money that the government doesn't have control over. Because with central bank digital currencies, everybody should know that's absolutely what's going to happen when the government is. So they'll be able to see what you spend every day, how you spend it, and shut your card off if they want to shut your card off. I know that sounds tinfoil hat-ish, but it's all about control, and that's where we're going. The other reason why Bitcoin might have some sort of use is, the crazy stuff that's going on, and yesterday's a great example with Donald Trump's mugshot. There could be a ripple effect around the world if, for some reason, the left is successful and throws Trump in jail. That would shake the markets big time, and you could see people run to Bitcoin to hide. I mean, those are the only two reasons I would say Bitcoin might have some legs. I was never really a fan of it, but now that I've seen everything kind of degrade around us, you could make a base case that it could be some place that you could hide from the government that wants total control. With central bank digital currencies, we rolled ours out already. It's called Fed now. It started July 1st. It's happening here. And then at the same time, if we do see some sort of market turmoil because they're successful and somehow throw an ex-president while he's trying to run for president in jail, that's going to be a market upsetting event too.
With the CBDCs, the central bank digital currencies, like Fed now, like you just mentioned, does that make America, expose America to a greater likelihood of the dollar no longer being the reserve currency? Does that, the concerns about, real problems if the majority of transactions are not done in dollars, the world over, or currencies like a digital currency tied to the dollar, does that have an impact? Does that hasten our demise as the reserve currency?
I don't know. Yes, it will have an impact, but I don't know how it hastens the demise. I mean, the reserve currencies have a lifespan of about 100 to 120 years. We're like in 105 years with the dollar right now, right? But here's what. Just think about it, though, right? If you've got an economy where you try to spur on spending, and the Fed would normally be cutting interest rates to get people to spend money, right? Make it not worth their while to put in the bank, make investments. The Fed now, they will just put it'll be the sell-by date. Your dollars will expire if you don't spend them by a certain time.
So your point, another feature of the control. Now they're going to, I mean, it's one thing to
now they're going to use it for monetary control for Fed. Yeah, exactly right.
And that's you're getting to sort of beyond incentives with interest rate signaling to literal control.
It's going to give you money that expires in 30 days.
Oh boy. Brave new.
Yeah, but everybody's embracing it because they're throwing away their rights for this idea of convenience, right? Oh, I hate getting cash. It's dirty. Well, you know what? You're gonna live to regret that, just like you did giving up your rights over COVID.
Yeah, exactly. Put your mask on, get your booster, and go spend those digital dollars that are set to expire.
Right.
Wow. Scott the Cow Guy, Shellady, market specialist for Market Day Report, 10:30 to 1, and host of the Cow Guy Close, 1 to 1:30 Chicago time, both at RFD-TV. Scott the Cow Guy, thank you as always.
All right, have a great weekend, guys.
Thank you, and he joined us on our turnkey.pro answer line.
Listen to podcasts of Dan and Amy from the AM 560 mobile app. Download it today at 560theanswer.com/mobile.
The Daily Herald 2022 Best of the Fox winner for Best Financial Planner is Total Clarity.